In the summer of 2000, my aunt took me to McDaniel College to attend the Baltimore Ravens training camp. I got autographs, ran the track with Hall of Famer Ozzie Newsome, and watched that year as the Ravens went on to win their first Super Bowl. I was sold. I was going to be a fan forever. But the following season, the worst thing imaginable happened. Tom Brady became the starting quarterback of the New England Patriots. I had to spend the next 2 decades watching Tom Brady win 7 Super Bowls. But something's changed this year. Tom Brady's gotten off to a slow start, and when they faced off against the Ravens 2 weeks ago, it felt so good to watch Tom Brady struggle compared to his usual stellar play and get frustrated as the Ravens won the game handily. Tom Brady's fans must be watching the games right now and thinking, what is going on? Where's all the winning? I'm Jeremy Reed with Advent Partners, and if you're tuning in for a market update, don't worry, you are in the right place. For those of you who aren't sports fans, I appreciate you sticking with me. But whether you're a sports fan or not, you probably feel like a Tom Brady fan when you open your account statement and ask, what's going on? Where's all the growth gone? For the last decade, we've seen strong stock market growth as our account values have kept going up and up. But this year, things have changed. Markets have been volatile, and our account values have suffered like Tom Brady's play. Even the superstars of the last decade, or dare I say the Tom Bradys of the last decade, have begun to falter. Meta, or Facebook, has lost 2/3 of its value since its 2021 peak. Google's parent Alphabet posted its slowest revenue since 2013 and is down 39% year to date. And finally, Amazon, once the largest company in the world, has lost almost half its value since the beginning of the year. Inflation and the subsequent actions by the Fed to contain it remains the driver of market volatility. The October jobs report signaled a healthy and resilient job market, with payrolls surging by 60,000 jobs over expectations. The pitfall being that the strong jobs report will encourage the Fed to hike interest rates longer than anticipated. Chairman Powell did indicate last week that it's likely time to lower the size of interest rate hikes, which has been 0.75% 4 times in a row now. However, his expectation of extending the interest rate timeline will likely cause an even higher target federal funds rate than anticipated a month ago. Also on our radar this week is midterm elections. Regardless of what side of the aisle you're on, you'll find some reasons to cheer or jeer this week. But markets are apolitical. They're more responsive to fundamentals than election results. Regardless of this week's election results, they will not offer an immediate impact to our country's inflation issue. Don't let politics cloud your long-term investment strategy and goals. I'm recording this video on Tuesday morning at the opening of polls, so we don't have any results yet. And the expectation, though, is that Republicans will take one, if not both, chambers of Congress. From a historical standpoint, gridlock, or one party controlling Congress and another controlling the White House, is actually a bullish indicator. Gridlock provides more policy certainty to markets as neither party can push their agenda at will. And what markets like more than anything else is certainty and normalcy. Before I go, I'll let Tom Brady teach us one last thing. I watched him play again on Sunday, and after another game of sloppy play, he led his team with a game-winning score with seconds to go. You just can't count him out, and he always seems to bounce back in the face of adversity. Markets are the same way. Portfolios are down, and it's been discouraging, but the season isn't over, and time hasn't run out. It may take longer than we hope, but they will bounce back. Thanks for tuning in for a market update. Please feel free to give our office a call if you have any questions. We'll be happy to speak with you.